Today, we're going to talk about investing in data center REITs. Now, the acronym REIT stands for Real Estate Investment Trust, and we'll talk about what that is. Now, the first misleading aspect of this label would be that data center REITs actually give you exposure to realty, when in fact, we believe that most of the exposure isn't from realty, it's from data center demand. So we think the risks associated with these vehicles happen to outweigh the potential rewards. Now, before we get into that, Andrew Carnegie once said that 90% of millionaires have achieved their wealth through owning realty. Well, Americans better hope that's the case, because here you can see three different income brackets, and the percentage shows the percentage of realty that occupies their wealth. So for the lowest income households, the home they live in is about 75% of their total wealth. That number goes down as people's income increases, but the point is that most people have all their eggs in one basket, with the percentage of their wealth that's tied up in a single house. And that's fairly risky, because when you invest in a single asset, then there's a lot of risk specific to that. Now, if you don't want to own a home and you still want exposure to realty, there are a number of alternatives like fintechs that are cropping up, or historically, the best alternative has been the real estate investment trust, which came about in the 1960s, and it allows Joe American to invest in commercial properties, apartments, storage facilities, malls, farmland, things like that. And data center REITs are just one of the many types of REITs out there that offer you exposure to particular themes. Now, the way that a REIT works is that investors buy shares in the REIT, and then the REIT takes that money and uses it to acquire assets that they then rent and generate income. And that income goes back to investors in the form of distributions, dividends. So one metric that they use in the REIT world is called funds from operation, or FFO. And there's a law that says to qualify as a REIT, you need to pay back to investors 90% of that number. Now, when you look at some REITs, you'll see payout ratios that are quite low, certainly under 90%. The question is, how can that be? Well, that's where you start to bring in principles of accounting, and it gets very confusing. So these are complex instruments, and we want to try to keep that as simple as possible. So for all practical purposes, REITs operate in taking money that you give them and purchasing properties you wouldn't be able to purchase, and then providing you with some of that income. So again, they're a way to get exposure to various sectors, and specifically real estate. Now, when we look at data center REITs, there are about 6 in total, and this table is taken from a firm called Hoya Capital, and they have a lot of great research on REITs in general. But here you can see there are 6 data center REITs, and we'll talk about what they do. But the two that we're most interested in would be at the top here: Equinix and Digital Realty. So we always invest in leaders. Whatever niche we're looking to get exposure to, we find the leaders. In this case, we can see the two at the top would be of interest. So we'll examine them a bit today. Now, when you look at how these companies operate, there's really 3 different types of business lines. The first is wholesale, and this is where they're leasing out data center space to firms like Amazon, Google, Microsoft, Apple. And you can see here the pricing to value is low. That's because the customer here has a lot of leverage at the negotiating table. So Amazon, Google, Microsoft, they collectively have 600 data centers. That was at the end of 2020. And that's about as many as all the data center REITs combined in the previous table. So they have a lot of data center space, and presumably they utilize some of these REITs as kind of overflow. So that would be a risky line of business to be in, because if things start to get tight, then those large firms may not want to pay the added fees of leasing space from external data center providers. And then you have co-location. That's where firms just look for a data center where they can put their servers. So the way that a data center typically works is they provide energy, they provide backup energy in case the power goes out. They provide the fiber pipe that allows the bandwidth to take place. They provide security, all those different things. And then you have interconnection, which is where firms will co-locate within the same data center to communicate with each other. So here they've given some examples of Verizon, AT&T, Comcast, T-Mobile, all being firms that need to communicate with one another. If you think about how back office systems work, then that would be the back office servers speaking with one another. So these are the data center business lines that these REITs will engage in. Obviously, they have different pros and cons. Now, here's an example of Digital Realty, one of the two biggest data center REITs. You can see here some of their portfolio statistics. So they have 291 data centers. That number, as what we're looking at here, is the first set of numbers. So these are, I believe, would be quarterly updates to this table of numbers. And you can see 291 data centers, and then they have a weighting average remaining lease term that's useful, and then their occupancy rate. So these are the sorts of numbers that investors would watch, particularly around occupancy. So Digital Realty is expanding very quickly, as is Equinix. And in order to do that, they're taking on a lot of debt. So they're anticipating that there's going to be a continuing demand for data center space. And they've taken on a lot of debt to build out their businesses. The table on the upper right, that is Digital Realty. They've taken on over $14 billion in debt. And then on the left here, you can see numbers from Equinix, and they've taken on close to $12 billion in debt. And at a blended borrowing rate of 1.72%, that's pretty darn good. And most of it, nearly all of it, is fixed rate debt. That's great. But the problem that you run into is when there's a crisis. And we took these bits. The intern that did this deck didn't put the credit, because this gentleman who put these points together certainly did a great job of doing that. When a REIT takes on a lot of debt, what happens is that when that debt becomes due in a recession, they need to go to capital markets when it's the least advantageous. So they have to figure out, all right, if we're going to either refinance the debt or manage to pay off that debt, then they don't have the cash on hand. So then what they need to do is they have to roll that debt over when there are falling rents. So in the case of data center REITs, we would substitute that for a lack of data center demand, or let's say falling demand. So some clients, maybe like Amazon or Google or Microsoft, may be choosing to host in their own data centers. And you have a dysfunctional debt market. And then here they mention a real estate equity market that has tanked. So the similar scenario for data centers would be the tech industry tanking. Though these data center REITs talk about how broad the sort of clients they have are across industry, there will still be tightening down the hatches when it comes to spending, regardless of what sector you're in. So what they're then faced with is the choice of issuing equity at unattractive terms or selling properties into a panicking market. Well, selling data centers, who are you going to sell them to? The other 6 companies out there that are in the same position that you are. So suddenly you have all this data center space that isn't being used, debt that's coming due, and potentially a crisis. So there's some risks that need to be considered here if there are, let's say, continued economic turmoil in the markets. Now, one great thing about these vehicles is that no single customer occupies more than 3% of their income. So you can see here, this breakdown, I believe, is from Digital Realty, and it shows a number of key metrics, the most important being that no single client accounts for more than 3% of revenues. And that's great. That diversification will certainly help their portfolio in times of stress, but these things need to be considered in terms of all clients that are utilizing the data center space being affected by an economic recession and how that impacts their, particularly all that money they're pouring into expanding their businesses. Now, speaking of diversity, one of the things that we noticed, particularly with Equinix, is this focus on diversity and inclusion, which we believe is damaging to shareholders and to companies, because it is. And we took this little picture out of their 10K, and it's just indicative of the sort of environment that D&I creates, where they want to build a culture of I'm safe, I belong, and I matter. Well, you know what? You're not safe unless you perform, and you don't belong to this team, and you don't matter if you can't do your job. So what will happen in environments like this, where everybody's belongs and they have days of understanding, is that people will gravitate to these environments who know that they can get away without having to do much hard work. And the rock star performers will hit the exits because they want to work at places where only the most talented individuals receive the highest compensation and are rewarded accordingly. So what we observed with both these firms is a lot of this lip service given to the D&I types, and we believe that's damaging to shareholders and damaging to these firms. And when times start to get tough, then we'll see how much that matters compared to actually having people sit down and do some work. That's why they're there. They're not there for a safe space or to belong or to matter. They're there to get the job done. That's what it comes down to. Firms have a fiduciary responsibility to their investors to do that. And we had just pulled up this particular metric which shows breakdown of Asians. In that previous picture, we didn't see an Asian person. We were trying to figure out how they could add an Asian when Asians make up half the world's population. So at least one person in that picture should have been Asian. And then who do you choose? Is it a Southern Asian, an Eastern Asian? So if it's a Southern Asian, do you choose an Indian, a Pakistani, a Bangladeshi? These sorts of things become very difficult when you expect the company photos to mimic the world's distribution of population types. So certainly, neither of these firms were appealing in that their cultures seem to be very weak. Now, why we own REITs isn't because we want exposure to data centers. We own REITs for a number of reasons. One is to provide a diversification effect, since typically REITs are weakly correlated to the broader stock market. We would argue with data center REITs, those are going to be pretty correlated to the stock market, in particular to the world of tech, which is where we already have exposure. So we're not looking for additional tech exposure. The diversification effect from REITs usually grows over time. So a REIT would be something you'd want to hold for a longer period of time. Now, for exposure to realty, that's why we own REITs, and we hold 3 in our dividend growth investing portfolio. We have 30 DGI stocks that we've invested in. 3 of them are REITs that provide a growing stream of income over time. So these are the reasons that we own REITs. And for these data center REITs, we're not getting exposure to realty, and that growing stream of income over time will be susceptible to downturns in the market and data center demand. So how we see data center REITs is that we're getting the potential return of a REIT while taking on the risk of tech stocks. So there's a disconnect between the risk we're taking on and the potential rewards. Now, when we look at REITs to invest in, this is taken from our strategy, Quantigens, and here's a list of REITs categorized by these different variables. So for example, years increasing dividends, if you multiply that number by 12, that's the number of years that these firms have increased dividends. All have increased over 25 years in a row. That's quite remarkable. So it's that track record that helps assure us that the income will increase and continue growing over time so that we can rely on it. And that's why we invested these firms. We own 3 of the firms that are listed here. Now, when it comes to exposure to big data, that's a different story. In our current portfolio, our largest position right now is NVIDIA, and that gives us a decent amount of data center revenue. So around, I think, somewhere in the range of 40% of NVIDIA's revenues now come from their data center segment. So we're getting that exposure to data centers, particularly following their acquisition of Mellanox. And that's something that we need to consider. Would we like more exposure to the potential growth of big data? Perhaps, and we may look in the future at some firms that will allow us to do that. But when it comes to big data and wanting exposure to that theme, we'll do it without investing in these data center REITs. Just to conclude, data center REITs seem to offer the risk of tech stocks with the rewards of boring old REITs, and that means the Sharpe ratio is out of whack. So the Sharpe ratio is a tool that investment managers use to measure how much risk you took on to get a certain amount of reward. In other words, if you invested in a single stock and got the same a return as the NASDAQ, then your Sharpe ratio is out of whack. You could have invested in the NASDAQ with far, far less risk and got the same return. So we'll be looking to play the growth of big data in other ways, not through data center REITs. So please leave your comments in the comments section. Make sure to subscribe to our channel. And thank you so much for taking the time to watch this video today.